Okay, so this is now being recorded. So welcome everybody. Welcome to this webinar. I'm Jon Courtney. I'm founder and CEO of Boardroom Advisors. And we're going to be talking today about grant, equity and alternative funding options as we come out of lockdown. And I'm in my conservatory, and unfortunately now it's pouring with rain. So if you hear tiny pitter patter, that's the rain on my conservatory roof. So there we go. So today we've got with us some experts. So from SeedLegals, we have Nick Richards. From Granted, we have Sara Palmer. And from Mountside Ventures, we have Jon Steinberg. So I'd just like you guys to introduce yourselves, who you are, what you do, a little bit about the company, just a couple of minutes so people have an understanding. Nick, do you want to start us off?
Sure, absolutely. Thanks, Jon, and thanks for inviting me today. So, afternoon, everyone. My name is Nick Richards, and I'm the head of investor partnerships at SeedLegals. Broadly speaking, that's basically a business development role. But to give you an overview of what SeedLegals is, for those who aren't aware, SeedLegals is effectively a law tech platform that helps startups and young business sort all the legals that I suppose are crucial in their growth trajectory. So if you're a startup, for example, looking to raise your next round of financing, our platform plus our human support is going to help you every step of the way in that. And the other kind of key offering we have is all around talent incentivization, so setting up your option scheme and managing all of that. And in terms of our history, we've been going for 4 years, but in that time we've become the largest closer of funding rounds in the UK. So that's an overview from me.
Brilliant. Thanks, thanks, Nick. Sara, do please tell us all about Granted.
Hi, thanks, and thanks for having us today, and good to see everybody here. So my name's Sara. I'm head of partnerships at Management Consultancy. So we are a non-dilutive funding agency, so a non-dilutive funding, that lovely free money. So we predominantly specialise in R&D, helping our clients to secure R&D grants, which plug that really nice spot between having a proof of concept and taking a technology to the market, often before companies are able to secure any funding from investors. We provide full non-dilutive consultancy, so that includes sort of helping companies to develop their innovation projects in order to get to the point that they're ready to secure grant funding, also R&D tax credits, and then the project management of those projects.
Cool. Thanks, Sara. And Jon, do tell us all about Mountside Ventures.
Yeah, sure. Hey, everyone. Thanks for tuning in on a 5 p.m. on a Thursday. I guess it's raining outside, but thanks for skipping the beers for this one. I'm one of the co-founders of Mountside Ventures. So we are a firm of chartered accountants that are laser focused on supporting high growth tech companies in raising institutional funding. So we support companies on how to prepare for all the advanced diligence requirements when you're raising off the likes of venture capital funds, corporate venture, venture debt, family offices, and EIS and VCT funds. So around kind of like financial modeling, investment planning, go-to-market strategies, investor introductions, and then supporting and I guess leveling the playing field of investor negotiations, because at the end of the day, VCs negotiate deals for a living. Founders only generally have to do it kind of 2 or 3 times throughout their growth cycle. And so having someone on your side who's seen hundreds of term sheets, knows what market standard is, and has had success in negotiating better deals is very valuable for founders who tend to be time poor and in reality should be spending more time with their clients and their employees rather than kissing frogs and going for little coffees and chit chats with VCs.
Brilliant, thanks, thanks, Jon. And I'm Jon Courtney. I'm founder and CEO of this one, Boardroom Advisors. We have over 100 very senior people throughout the UK who have all scaled businesses. We act as non-exec directors, or more likely part-time executive directors, such as part-time finance, marketing, sales, IT, even managing directors. Our clients are funded startups, scale-ups, and SMEs. And my contact details are in the chat. And do please put your own contact details in the chat, and please, in particular, if you've got any questions as we go through, do please put them in the chat and mark question, because I'll be hurriedly looking at those while the others are talking, and so we'll try and tackle some of those at the end, if that's okay. So no further ado, let's have a look at some of the trends that we see, and let's start with granted with Sara. What government funding is coming out of the transition out of the EU, Sara?
Okay, yeah, really interesting, and it's going to be a fairly vague answer, but I will explain the reasons. So obviously, so the government has announced, and as they promised over the last few years, that coming out of the EU, that the R&D budget for the UK would be expanded, and they've kept to that promise when the budget was announced. However, it hasn't yet been announced really what those funds are going to be. We predict that they're going to be in the high-tech areas that follow the general trends, so the clean tech, agri-tech space, for example, health and life sciences, biotech, plenty in sustainability, circular economy. Those are the sorts of sectors that it's going into, but we're still having a bit of a delay in terms of the actual funds being announced. And I think, as well as coming out of from the EU, obviously we're losing a lot of the EU funding. And the government is talking about this levelling up program, which is going to replace the RDPE funding for the regions, and also shared prosperity fund. But again, the details of it haven't yet been announced. So that goes along with a reshuffle politically with the UKRI, which is the UK's largest funding body for R&D. And also a lot of the funds last year were obviously sidetracked to focus on solutions for COVID. So yeah, it's going to be all of the funds that we would expect to be released directly from the budget are still yet TBC. I think they're sort of delayed into Q3 for this year rather than Q2. But we do expect them, like I said, to go in the areas that we would expect of the usual industrial strategy. So the clean tech space, the digital health space, agri-tech, and anything involving sustainability.
And Sara, we've at Boardroom Advisors, one of the things we've been helping people with is the Internationalization Fund, which is a horrible mouthful, where there's up to £9,000 available in match funding for people looking to export, to help them export. And this was launched before Brexit, but it has continued and possibly has maybe another year or so.
Yeah.
It's a DIT grant. Do you get? We're getting involved with that. Do you get involved with that at all, or is that outside your remit?
We do. It's not one of the core funds that we specialise in. For example, so the core funds that we specialise in would be more the kind of Innovate UK, BASE kind of funds, but we do get involved with some of the larger international bids, for example, and we do know that, fortunately, again, it's not exactly clear how, but that we will still benefit from the Horizon Europe programme, despite no longer being an EU member, and also the Eurostars programme, where you don't actually have to be an EU member to access it. And I know as well that the core focus, or one of the core focuses for a lot of the UK funds this year will be on the export potential of new technologies for the UK. That international competitiveness is really going to be pushed and driven. And there's a lot of talk about the new Innovate UK CEO who joined, I think, in the last few weeks, that they're very much keen to steer towards commercial projects rather than research projects. I think when we had a catch up with this webinar team a few weeks ago, John, you were saying that there's that kind of rumor of, you know, a lot of R&D funding going to academics, which is great. We need the experts, but then companies getting lost in that trap of getting grant after grant, but never actually taking things to market. But I think that's gonna change now. I think the commercialization, the export potential is going to be really key.
And certainly what I'm seeing, and I think what you've just hinted at, is some of the European grant funding that even though we've left Europe, we'd committed to before we left, before Brexit, and still has some of those still have some time to run before the next round, and then we're not in the next round. Is that right?
So the Horizon 2020 program has come to an end. So the new Horizon program is being released anyway, and like I said, it's not entirely clear how at the moment, but as far as rumours go, we will still have involvement in that for the new program going forward.
Cool. And so grant funding. So it's non-diluted. I can't get my words out. You don't dilute. So tell me about the pros and cons of grant funding and non-dilution, and what non-dilution means to people.
Cool. So it's essentially these companies aren't. It's not debt and it's not equity. So you're not giving away shares. You're not diluting your cap table, and there aren't associated costs with it with regard to debt and payback and so on. The idea is that these grants. And as well, important to point out that R&D grants aren't for any particular size of company. It doesn't. You could be a complete startup micro business. You could be a large corporate. I believe as long as you've got, I think, under 50 million turnover, you can still apply for government grant funding, because it's all about whether or not you've got a project coming up for creating a new technology. And the idea is that the grant plugs that gap between having that idea and that proof of concept and all of the R&D activity, and it will fund up to 100% of the costs to take an idea to the point where you have an MVP or a MMP or prototype, whatever it is, ready to take to market and commercialize, which is where a lot of other funding tends to be unlocked. So it's that bit in the middle. It's the government's way of incentivizing companies to take ideas and that will provide a solution for the UK economy with wider impacts, whether that's economic or it's going to solve a regional problem or a social problem, whatever it is. But it's those high risk technology projects, if you like, that solve problems for entire industries that are game changers, essentially. And the government wants to incentivize businesses to do that, so they provide up to 100% of the funding for all of that R&D activity. So that would include involving experts or subcontractors to help you take that to market, academic researchers, any equipment that's needed will fund that gap. So for a lot of companies, they don't have access to funding from elsewhere. So that's obviously a huge pro. And if you do, it's a very, very competitive process. If you are so lucky as to secure grant funding from the government through that process, it does provide that wonderful validation to then go on and seek further investment. So it's really key. But I guess the cons, it's government money, so it's hugely bureaucratic. It's a lengthy process. The application process itself takes, it might even for our grant writers, it might take 4 to 6 weeks to pull together a really good bid, because essentially you're pulling together a dossier to enter the competition. Then you might be waiting a few months to find out whether or not you've been successful. Then there'll be a due diligence process, and they're also paid in arrears. So the company would have to have some cash flow to start the project before the government then reimburses. So it is hugely bureaucratic. Hence why we have a project management service for that for companies. But like I said, it's funding that companies otherwise might not have access to and wouldn't be able to chase these wonderful ideas down the rabbit hole to bring them to market without.
And everybody loves free money, right?
Yeah.
You have R&D tax credits as well, which are pretty significant
Yeah.
if you can't win a grant. And there's been some quite interesting updates to those, actually, which really affects early stage companies. So they've actually implemented a cap on the amount of R&D tax credits you can claim back as a link to your PAYE and NICs that you've paid on your employers. So if you're an early stage
there's a lot
company,
of change, and the HMRC basically released a huge amount of funding for tax credit fraud claims going forward. I think there are a lot of companies out there that claim to specialize in R&D tax credits that companies have claimed without actually, you know, having gone through the process of creating an innovation, so they weren't eligible in the first place, for example. So it's really important when engaging a R&D tax credit specialist that they are a specialist. It's not just an accounting exercise. It's really about understanding the activity that you've done. And tax credits are that, if you think about grant funding is about funding defined projects that a company is going to do, the tax credits are the other side of that project. They're that retrospective non-dilutive incentive from the government for the R&D activity that's already done. Got
it. Cool.
Yeah, and I definitely, if there's any founders on the call who have R&D projects and are claiming R&D tax credits, I definitely advise investigating kind of your potential claim now that the rules have changed. Because if you're using an outsourced tech provider, previously you can only claim I think 60% of that back rather than a full 100. But with the new cap, it's definitely worth forecasting what your cap would be, and if you need to internalize some dev to boost your cap up rather than fully outsourcing the tech, which isn't something that the founders have had to really think about as much previously, but it can have a big effect on the early stage if suddenly you can't get your R&D tax credits back because you've outsourced 100% of the dev and you don't have enough, you haven't paid enough employee taxes to be able to claim back what you're owed.
Exactly, and there are two schemes as well with tax credits. There's the SME scheme and then there's the RDEC scheme, and they have different claim back rates, and activity can be claimed. You can claim from the SME scheme and the RDEC scheme. So, for example, if you've done a grant project, you can actually claim back tax credits on the grant funding that you've secured as well. It's just under a different scheme, and you can claim that alongside tax credits under the SME scheme for general activity that the company's done, and they do go hand in hand. But again, you need to engage an expert to make sure that you really are claiming it in the right place. It's a really good point, John.
And R&D tax credits are brilliant. I remember in my previous company, I claimed back tens of thousands. I was always surprised what things could qualify under an R&D, and I didn't think they were necessarily research and development areas, but you know, the definition was relatively wide, is what I found, which was excellent for me and for my business. Things may have changed, I don't know. Listen, Sara, thank you. That's very clear. We need to bring Nick into the conversation. Nick's with SeedLegals, and so you're one of the largest closer of funding rounds. Nick, you and your colleagues. Are there any trends you're seeing on how entrepreneurs are raising capital at the moment?
Sure, absolutely. And I think, speaking from SeedLegals' perspective, I can certainly talk about two things. And then from speaking to both founders and investors on a day-to-day basis, I suppose talk about new emergent things. So I think one of the key trends which existed, to be honest with you, even pre-COVID, but I think has accelerated further during COVID, is this whole concept of what we call agile funding. And for those who aren't kind of familiar with what that concept is, it's probably better to talk about what the old model of fundraising is. So the traditional kind of old, startup method of fundraising is to try and basically herd a bunch of cats together to basically all commit their checks to commit their money at one point in time. So you want to go out and raise 500k, a million, 2 million, whatever. You want to get everyone on the bus at exactly the same time. And that's an incredibly time-intensive exercise for founders. And obviously, the longer that draws out, the more volatility there is in that kind of raise falling in. How investors get cold feet, their appetite changes, and that in turn can compromise the whole status of your raise. But what we saw, I suppose, before COVID, and I think has accelerated during COVID, is founders take a completely different approach to that. So rather than go out and try and raise 200k, 500k, 1 million all in one go, they think, well, actually, hang on, what if I could do effectively like a series of micro raises? What if I've got an angel who's willing to commit to me 5k, 10k, 30k now? that's actually really useful to me right now. It might mean that I can go take on a contract or, you know, hire a new developer that effectively gets me closer and closer to reaching my next milestone, which for a founder means, you know, a good few things. So one, my business is more progressed. So when it comes to raising in the future, either the valuation I have in mind is more solid, or maybe I can go and, you know, get a higher valuation. And then secondly, I think, you know, it instills more confidence in investors who you are trying to raise from at that time. So it effectively means you kind of bring, well, rather than trying to get everyone on one bus at the same time, which is how the old model was, rather you can kind of bring people on at different times on different buses. Think of it for anyone who's been married and had to escort people from the church to the wedding reception in a series of cabs, and that could be a bit of a nightmare. It's actually quite useful for founders in that respect. And I don't know whether this agile, look, I don't have all the answers, but, you know, a certain theory I have for this is, one, you know, during COVID, there was a lot of sort of a lot of VCs out in the market saying, yes, we're open for business, we're open for business. I don't know if that's actually the case. John might be able to comment on that better. I certainly know of kind of the more esteemed VCs saying, actually, no, we need to pause here because there's a lot of uncertainties right in the world we can't, you know, I suppose, fully fathom yet. But what I will say is, this comes on to my second point of what, I'm not going to call it an alternative method. I just seen it really burgeon. So at SeedLegals, for people's background here, the majority of funding rounds that take place on our platform are generally in the pre-seed and the seed space. So anything from, say, from 150K all the way up to a 2 million round. Now, I come from an ex-VC background myself, and you know, previously, if I'd seen a 2 million round, I would have thought, oh, right, okay, there's a fund probably who's been the cornerstone investor there, put in anywhere between 500K or maybe writing the whole 2 million check itself. But actually, what's really surprised me, particularly during COVID, is seeing these really, really large rounds. So, you know, 500K, 2 million plus, have been completely occupied by angels. There's not a single fund in that funding round. And I think, well, that's obviously a good thing, particularly as a founder, because angels generally, other than obviously the free money from R&D tax credits and grants, angels are your cheapest and your quickest source of capital. But, you know, I don't know whether this is founders going more to angels because they felt that's that source, but at the same time, I also kind of feel like in COVID, let's be honest, if you look at the business world, the magnifying glass has really come on tech. Unless you're kind of a traditional business selling face masks, the only businesses who you hear doing well at the moment are online digital things. So the Zooms, the Amazons, the Facebooks, all that kind of stuff. So I think there's been a real magnifying glass on tech, and thus I think there's been increased angel appetite to invest in these businesses. Thus, it seems to me that it's actually kind of a lot easier, or you can win angels a lot quicker. And then furthermore, I think, you know, with COVID, at least for people who are in that kind of in the fortunate position of where their jobs aren't too impacted by it, they can do everything remote. There's obviously as well like a lot of pent up cash. So there's a lot of pent up cash, people wanting to, you know, maybe, you know, try investing, and there's been a lot of tech that's obviously helped make that easier. So, you know, SeedLegals, I would say, obviously for the legals, the crowdfunding websites, etc. So I suppose those are the trends I see within SeedLegals. The other thing I've seen over the last few months, and you're seeing a lot of companies flourish in this space, is this whole concept of revenue-based financing. So for any of those on the call who aren't familiar with what that is, it is effectively debt, but it's not like debt where you basically have a kind of a fixed interest rate. Rather, it's debt that's provided to you upfront. You pay a fee on it upfront, but basically you pay back a proportion of it out of your revenue every month. So if your revenue goes up, you pay more. If your revenue goes down, you pay less. So it's regarded as kind of like a, you know, sort of a flexible lending. The interesting thing is you're actually seeing even VCs offer this. Not all VCs, only a few at the moment. So that they offer this revenue-based financing. But you're also seeing, you know, there are companies out there, for those who aren't familiar, there's Clearbank, there's a company called Uncapped, but there's also Pipe. The sums they can provide is anything from 10K up to 2 million at the moment. There are caveats to it in that there has to be quite a lot of visibility on your revenue. So generally they like digital businesses where all their transactions are online, and often they will stipulate what they want that money to be spent. So for example, like Facebook advertising or something like that. But it's quite an interesting and I think potentially disruptive kind of like rival finance to venture capital. But then even for a lot of people, entrepreneurs on the call here, I would say actually it's also good because most a lot of businesses aren't VC backable at all, and that's not a criticism of the businesses. They just don't fit with the VC model. So yeah, revenue-based finance, I think, is kind of the real interesting alternative I've seen come out of this market.
Brilliant, thank you. And John, what trends have you seen in VC deals recently?
Yeah, I mean, a lot of what Nick was saying. I guess to go into, so where we sit is, I guess, what you traditionally call a Series A round. If you're looking to raise seed or angels, you probably don't need an advisor. It's more about you as a person and your founder and you as a founder and your expertise and the market opportunity. When you go into a Series A round, it becomes a lot more about data and financials. And over, I guess, the COVID period, where we sit, we work with a lot of kind of B2B enterprise level companies, and sales cycles got significantly extended. People's growth rate dropped off, and you never want to go into a VC round when your growth rate is dropping off, not accelerating, because that's not a good negotiated position. And so lots and lots of companies that I've worked with, and I'd say 2-3 years ago, I'd never really seen this, have people like Clearbank who fund their marketing spend up front and then push the cash flow back like 3 or 4 months. So that gives you the opportunity to like get in a bridge round or some equity, but still maintain that growth up front. Revenue-based finance is a dream for e-commerce, subscription businesses and the like, because I think Uncapped sell themselves that in kind of 24 to 48 hours, they can suck in all your data. They charge you like, I don't know, 5% fee, and then you just pay that back out of your revenue. So instead of having to like scramble around giving away equity to angels and the like you can keep your marketing spend up, you can keep your growth rate up without having to take your foot off the gas pedal and go around courting angels to keep that acceleration up before going out to a VC, which is so important, because in reality, it's kind of, if you're on a high growth trajectory and you think you can be a 50, 100 million business, every day that you spend out of the business is worth tens of thousands of pounds. And so if you have these kind of alternative funders who can give you facilities in a quick amount of time and allow you to just keep going and spend more time with your clients and your employees and your technology, it makes an astronomical difference. And so instead of, I guess, what I traditionally saw as a bridge round, which generally looked like a convertible loan note, that was kind of all the bridge rounds I used to see. Now there's so many options to bridge yourself in between funding rounds, because and agile fundraising hasn't quite hit the institutional VC level. It is still very much kind of, we're opening our round. We want to close in 3 to 6 months. We'll speak to 50 funders and then we'll make our decision about who to bring in. Unfortunately, I guess with VCs, they're not investing in their own cash; they're investing in their limited partners' cash. So they have to go through kind of the whole diligence process and get to know you and tick all the right boxes, so that if your business does go tits up and you don't return anything for the fund, they can tell their investors that they ticked all the right boxes and therefore they shouldn't get fired.
Do you have a question for Nick and John? I don't know if this is still a trend from a couple of years ago when I was working more in the equity space. I saw a lot of businesses, particularly kind of e-commerce businesses or I guess any form of digital tech platform, where they engage a software development agency that is offering sweat equity. So equity in exchange for services. Is that still a fairly big trend? Has that moved on?
I almost, unless there's a real need for it, I generally try and advise companies to, if they can pay in cash, pay in cash.
Yes.
Because if you're on a high growth trajectory and you think you're going to be a 100 million business and you're giving away 1%, then you're giving away potentially £1 million for what, like a 50 to 100 grand development project. And so the multiple doesn't make sense. I do see it. One of our clients at the moment, who actually did both their rounds through SeedLegals, there is kind of 2 mil in November and 2 mil again about a month or so ago. They really like their development agency. They want them to be around. They want them to be incentivized to support them and meet deadlines and get them to the Series A. So it's a way of them incentivizing their outsourced development team to actually meet timelines, build a good product, because then everyone wins.
Yeah, I agree basically with what John says. I mean, what we very much do at SeedLegals when it comes to issuing equity, I suppose, to people who are supporting you in your journey, whether it's a development agency or an advisor, is to pay them in cash, because particularly with advisors, as we say at SeedLegals, ideas are cheap, execution is what is expensive. But in terms of trends, in terms of outsourcing tech agencies, I mean, I've been at SeedLegals nearly 2 years, so I suppose I don't have the kind of full history of what like a few years ago. I would say, obviously we do get companies who, outsource tech resource, but to give equity away, I would say as a party line, generally no. But to echo John's point, I think you have to look at it on a case by case basis and really understand, I suppose, at that point in time, what it is they're offering to your business, and I suppose how significantly, is that going to help you versus maybe what other people do. So, for example, I have an old friend of mine from university who's with his pre-seed startup, and he has an advisor on board. And this advisor actually is kind of a leading academic in sort of all the maths that underpins their offering. So in my view, it makes sense to, given they are kind of a very lean startup at the moment, to give that guy some equity, because there'll be a long-term engagement with that person for the business. Evidently his insight is going to be critical to the value of that business. So I like you some equity is worth it in that instance. But if it's kind of like a commoditized resource, like to some extent, tech, you could say, unless the guy you've got is like, the only developer in the world who can do what it is you're building, then yeah, you might argue there's some merit for equity there.
I think the key message is to get somebody to look at the terms first, because I also know that when I saw a lot of this in the past, that there was quite a big kind of hidden underclause about who the IP, if you've got somebody who's taking equity and developing a platform for you with their service terms, who owns the IP in the end? So that's another really key thing to look out for.
Yeah, absolutely.
Another thing to think about as well, if you are looking to bring in advisors and people for equity, is get them on a good vesting schedule. Unless there's a really good case for it, don't give them everything away on day one. Give them their allocation, let it vest over a 3-4 year basis. And then because people get bored and people move on, and they might seem like the most invested person at this moment, in a year's time, and if they got married or they want to move to Australia or have kids, you want to have the mechanism where they've only earned 25% of it, so they only get 25%.
Another suggestion as well, rather than either alongside or alternative investing, is also, if it's possible, some sort of milestone thing. I mean, the problem with milestones is obviously they can be kind of very nebulous definitions, but ideally, if there's some kind of clear deliverable that person can bring to your business, like, I don't know, help brokering a contract, for example, with a major partner or counterparty, that could be a useful thing. And
guys, what about types of funders? I mean, we all know about individual angels and crowdfunding, but John, what other types of funders are there out there that people should be considering, particularly, I guess, at Series A also?
Yeah, the main thing that I spend a lot of my time working on now that I never did 2 years ago is venture debt. So people used to open up their Series A round, they'd get in an equity VC, they'd raise £3 to £5 million. 12 months later, they raise 5 to 10 mil Series B, and so on and so on. Now you have venture debt providers who, if you raise a Series A of kind of 3 million, they're happy to rely on the due diligence of the equity investor and give you a facility for kind of 3 million. And that will come with like 10% interest rate, 11%. But if you have the revenues and the cash flow, it's astronomically cheaper than giving away equity. Because again, if you're on that 50, 100 million exit track and you think you can get a very good exit in 5 years, like you can get one of these 3-year facilities, and you can use it for a lot more. Like you can use it to acquire companies, you can use it for lots of stuff that VC equity, they don't want you using it for.
So John, just to be clear, so this is debt financing, but it's tied to the growth and scaling of the company, is that?
It's debt financing for companies that traditionally couldn't get debt financing. Debt financing traditionally, as up to about a year or two ago, was for EBITDA positive companies. This is for loss-making companies who in 2 to 3 years are expecting to be profitable then. And you can raise kind of 3 to 5 million off the back of a couple of million equity raise, and pay 10% interest. You give away kind of 5 to 10% of the facility amount as warrants to give them a little equity sweetener on a potential exit to reduce your interest rate. But if you're on that high growth trajectory and paying 10% on a 5 mil facility per year, it gives you kind of what, like 1.5 million that you would have paid in interest over a 3-year basis. And if that means that you haven't had to give away an extra 20% of your company and you're on that 100 million exit track, that's 1.5 million of interest expense versus 20 million of equity that you would have had to give away for the same amount of cash at that point. So there's a lot of providers that are popping up all over the place at the moment.
I was about to ask John, because this is, I suppose, from previous roles I've been in, I understood for venture debt, generally it had to be quite a major ticket. So the only kind of player I knew out there at the time was Silicon Valley Bank, and it seemed like the only people who could provide venture debt were large enough organizations with big enough balance sheets to suffer the potential losses. So for example, you heard of Silicon Valley Bank. Now I have no idea what the minimum check is. I presumed it would be in the Series B space. I don't know, maybe 10 million, maybe even more. So I mean, is that market, has it become a lot more competitive? Are there a lot more providers out there? And also, are more people eligible for it now? Because from what you're telling me, it sounds like you can actually get kind of the smaller sums under venture debt. So, you know, relatively speaking, like in the, I don't know, 5 million. I don't know if that's the figure you gave there.
Yeah, far lower than that. The one we worked on recently was 2 million.
Right, okay.
And bear in mind, this isn't like traditional debt. It doesn't come along with personal guarantees. It's unsecured. And it follows the same trend as VC funds. Like all the Series B and later stage VC funds are opening up seed funds because it gets too competitive for deals later on. And a lot of these venture debt houses that actually realize that to build a relationship with a company that would be 4 or 5 million in revenue and really profitable, then like you have to go earlier. Like you have to start looking at companies on like 1 million in revenue who are growing fast, because if you don't get in early, then you miss out, because by the time a company gets to the Series B level now, they know they're the investors, they know what they're doing. There isn't really kind of the same kind of the same funding generational approach that used to be. Everyone's going early. All the Series B, Series C funds are opening up seed funds. Yeah. All the US funds are now opening up offices in London, which is quite funny because all the UK and European funds complain about how overvalued all these deals are, but all the US funds are saying it's so cheap over here compared to where we are. And I was listening to an interview with one of the managing partners of Insight in the US. He was saying he regularly sees companies at 10 to 14 million ARR dollars asking for $1 billion valuation now in the US, which is pretty unheard of in the UK or in Europe.
Right, great stuff, guys. Listen, we need to come to some questions. So let me just throw some out at you, and please chip in if you've got a response or an opinion. So from Rick, hi Rick. If, as we already have 2 UK grants, are we able to claim R&D credits as over the de minimis level? It's probably for you, Sara.
Yes. I did say at the very beginning of this so that I hope nobody asks me about things like state aid.
Sorry.
It's best to be an expert, and I'm certainly not the best person at Granted to speak with, but we do have experts in-house. I did respond to this. It's not a straight yes or no answer, because it depends on whether the funding that you've achieved has hit that state aid level. But also, we're now outside of the EU, and it's not, again, fully decided what it looks like, but it's whether or not we're still going to fall under that that cap and when you're claiming and what your projects were. So it's not a straight yes, no answer. It needs an expert to look at it. So get in touch.
And state aid is a bit of a mess at the moment as well. Because, for example, one of the deals we're working on at the moment is with a European VC. But actually, most European VCs have European Commission money as their limited partners in their fund. And so one of our clients is going through a funding round where they have a term sheet from a VC, and then they're a Scottish company, and the Scottish Investment Bank said, yeah, of course, we'll match fund it. We'll match fund it. And it was all progressing really nicely. And then suddenly we found out that this VC, actually 33% of their money is European Commission money. And then there's parity rules whereby 50% public has to be matched by 50% private. And now suddenly there's 66% public in this deal, and now we're scrambling trying to find some private money to top it up to bring the ratio back down. And no one we spoke to can tell us. Everything online suggests that government subsidy rules have diverged, except for in the case of Northern Ireland exports. I think I've read a lot about this recently. Yeah, and but no one wants to pull the trigger on a deal because everyone's too scared, and no one actually knows.
Great. Okay. Question from Andy. Thoughts on issuing equity for services, but with call options? Anybody got a comment on that?
If there's more context on the call option, I can comment. But yeah, equity for services at the early stage is super standard before you've managed to raise funding. Otherwise, the founder has to pay for everything out of pocket, right?
Right. Okay, and a question from Joe, who arbitrates on milestone vesting? I prefer milestones are time served, but it's equally hard to really forecast the future. How does a missed milestone get handled in terms of vested shares?
I think, well, not that I'm the lawyer here, by the way. I work in the biz dev team, but as someone who's done deals in the past and been involved in negotiation and contracts, I mean, in terms of the arbitrator of milestones, I mean, that's honestly is purely going to depend on what the contract says. And I think largely who arbitrates that will also be dependent on I suppose what the milestone in question is. So obviously, say if generally when it comes to milestones, if you can make it something, you know, really, you know, undebatable, like, you know, as in, you know, what day the 4th of June 2022 will be or something like that, and that's fine. And then sorry, there was another question related to the milestone. What happens? So I mean, I must admit that situation of having both milestone and vesting for advisors, I mean, I think you need to look at the specifics of that situation to comment further.
It's very hard for advisors to do milestone because it's like advice isn't a project. If the company I was speaking about earlier to develop their development agency, the milestone is very easy. They bring out this feature, it's tested, and it's live in the app. And if it's not, then they haven't hit the milestone. But like for me as an advisor, like, well, how long's a piece of string? How do you judge the milestones of the value that you've added to the business over time? So for advisors, it's probably better to vest on a time schedule basis. For project-based work, yeah, that probably makes more sense. For milestones, and to be honest, when you say who arbitrates on milestone investing, if you get to the point where you need an arbitrator, then everything's kind of fallen apart anyway, and you probably have more important things to worry about.
Okay, brilliant. And a final question from Jaylen. Could someone give me a summary of all the tactics that can be now used to obtain funding? Well, perhaps rather than all of the tactics, because we could be here until midnight, perhaps maybe let's just whiz around the room in the current circumstances. So that is Brexit, coming out of lockdown, all of the stuff that's happening and has been happening. You know, if you had to perhaps one or two tips in your area of specialism that you would ask people to have a close look at. Sara, where would you start?
Sure. I mean, it largely depends on the stage that the company's at. I mean, I've talked about how, so Granted specialise in the R&D innovation grant space, and I think understanding the right timing for getting R&D funding is really important. On the other side, from R&D grants, you have capital or structural grants, which could be anything from, you know, startup grants or business support grants from 5k plus for startups, all the way up to big capital expenditure grants for sort of 50, 100k plus. And they are, rather than the innovation or R&D grants that are distributed nationally, those tend to be distributed regionally. So in England, for example, that kind of government money is distributed through the local enterprise partnership network. So you can look up your local enterprise partnership or LEP. Each one of those, and there are 38 across England. Wales have their own, Scotland have their own, Northern Ireland has their own. There are 38 of them just in England alone, and each one has a growth hub spin out, which is basically the government's business support services for all of the companies in that region. And that is where you will be able to find out about any grants, any smaller or capital expenditure grants that are more relevant to you. And I would encourage every business to have a contact or some kind of relationship with their local growth hub, because that way you can find out about any smaller grants like that.
Yeah, excellent idea. And we're partnering with one or two growth hubs ourselves. Excellent source of information about business generally, as not just grant funding, but business generally.
Yeah, we'll have free accelerators, competitions that you can enter, webinars, free funding sources. Yeah,
absolutely. Nick, one or two tips in the current climate that you'd, I know it depends on
sure,
how
absolutely.
much they're raising and all the rest of it.
Yeah, absolutely. So I mean, maybe this kind of nice trajectory here, because Sara's talking about sort of, you know, grant funding and stuff. You know, for me, obviously try and get free money, but look, I think particularly for anyone, you know, raising, I would say between, you know, let's say anything from 50k all the way up to 2 million, seriously don't overlook angels. I came from a VC background before coming to SeedLegals, and I didn't actually realize like what actually fantastic ecosystem we have here in the UK with business angels. You know, it is heavily incentivized by the tax incentives, so SEIS and EIS. If people aren't familiar with what is, that basically allows angels to recoup money on their investment that they invest in you from the government, so it de-risks it for them. But I mean, I don't have the geographical knowledge here, but the US has nothing like this, and that's the most vibrant sort of, you know, later stage.
Something the UK needs to hold on to.
Yeah, absolutely. There was worries that would go away, I think, in COVID, but thankfully it stayed. And I argue it's the lifeblood of the early stage ecosystem. So, by all means, you know, I think what's happened in our, you know, where the magnifying glass has been on tech over the, let's say, even like 20 years with likes of Google and Facebook and Uber, you can see companies go like that. And those companies get celebrated, which is great, but the VCs also get celebrated too. Now, there are some very smart VCs out there, but some VCs, I think they get a lot of fame attributed to them, and I think a lot of startups think that's the way to go. But as I said, most businesses are not actually VCable, and you know, angels are a fantastic source of capital, your quickest, cheapest source of capital. They're not under the same financial pressures or models that VCs have to adhere to. So definitely do you know, try and exploit that field. The problem with angels is obviously, unlike a VC firm, they don't have websites, they don't market themselves, they're not on the Twitter sphere. So you've really got to, I suppose, you know, tap your own network, and I suppose find a way to access them. In the chat, I put a little guide about how to, I suppose, try and, you know, find angels, because, you know, at least in the initial stages, it's to do with your network. But trust me, there are ways, you know, you can do it. Make noise. If you're a startup, absolutely make noise. All about making yourself seem bigger than you actually are. And then if you can get into that position where people are coming to you, obviously that's a great position to be in.
And it's also partly a sense of scale, isn't it? Because, you know, to be really simplistic, in startup land, angels are everything. But of course, when you get into scale up land and you're looking at Series A, then angels don't disappear, do they, John? But you know, the institutional stuff becomes much more to play. So a couple of tips for people in the larger space, John.
Yeah, and I'll throw out a quick tip off the back of Nick's angel comment, actually. One good tactic if you're struggling to find business angels is find a company similar to yours that might have had a partial exit, like a Series B or secondary market. Find all their early angels who are on their cap table that you can look at on stuff like Bowhurst or Crunchbase, and then they would have got a win in the market, and you're like, hey, so you got a win. Do you want to double down? I'm the new kid on the block, and it's a way that if you don't have, because to be honest, like angel networks are quite closed doors, like they are very hard to get into, and not every founder went to Eton, unfortunately, and so sometimes you have to get a bit scrappy when you're trying to get there, and you have to try some quirky little things like sending cheeky messages to someone you know might have got an exit in your space, and trying to get them in off the back of that. In terms of VC funding, and I prefer talking about institutional funding because corporate venture as well is like just as big as VC when you look at it on an overall basis. My advice is to understand the worth of your own time. Your time is probably, until you're hitting the $500,000 to $1 million revenue levels, your time is much better spent with your clients, employees, and technology, and getting new clients rather than spending an hour having a chin wag with a VC analyst who's probably just on a fact-finding mission anyway. When you have tapped out angels and you do have good early clients and you really feel like my tech works and my clients are happy, that is the point where you go out for VC. Unless you have those signs of product market fit, all you're doing is burning your own time. You'll speak to 50 VCs, they'll all come back, they'll all have the same feedbacks and come back later. And raising seed VC funding is good if you can't raise angel funding, but surely if you can raise seed VC funding, you should be able to raise angel funding. And angel funding is easy, they're supportive. You don't have to send them monthly management accounts. You don't have to ask their permission to hire someone or fire anyone. You don't have to ask their permission if you want to do something or pivot the business or try and go into a new market. As soon as you bring a VC on, you get 4 pages of stuff that you have to ask permission to do. Like you have things like anti-dilution ratchets. So like if you get 20% at a 10 mil valuation, and then actually you need to raise at a lower valuation next time, they don't get diluted. They get to retain their 20%, and you have to give everything away out of yours. So have a think about, is seed VC, is it the kind of person that you want on your board, because you have to give them a board seat, and do you really think that it's best for your business speaking to 50 VC analysts at this stage, when you can do it in more of a competitive process, when you have something to show off about, instead of the promise that you'll have something to show off about in the future?
Brilliant, guys. Listen, thanks so much. Wonderful questions. I'm conscious it's 2 minutes to the hour, so we're bang on time. So I'd like to say thanks very much to our panelists. Nick Richards from SeedLegals, Sara Palmer from Granted, and Jon Steinberg from Mountside Ventures. I'm Jon Courtney from Boardroom Advisors. Thank you, panelists, for coming along. Thank you, everybody, for listening. A copy of this video will be on all of our sites, certainly ours. I expect everybody else's as well, probably next week. Thank you, everybody, for coming along, and have a good evening.